Good, how are you? Yeah, you too. You're a good speaker.
We've got a couple of people that are outside the conversation, but I think we better get going.
You want to go ahead and start?
Dwayne said it's time to start.
We're pleased to have Bob here from the state FSA office. He'll be here all day and gather our thoughts and what we're working at and what's going on with the Farm Service Agency and any changes in loan programs for under the new farm bill and all the details therein. So we're pleased to have Bob here with us today, and thank you for taking the time out to be here.
Thanks, Dwayne. I'm glad to be here. Glad to speak to you all regarding Farm Service Agency, our loan programs. I do appreciate the meeting you guys are having and the efforts that you're undertaking. We're all aware that there's a substantial decline in commodity prices, and that's certainly going to impact a lot of the customers that we work with, a lot of the customers you work with, many of those the same customers. And we appreciate the efforts and the assistance that you're here enough to provide those customers. As I go through, I've got a little PowerPoint that kind of explains our programs and touches on some issues. Feel free to interject with any questions or whatever, real informal scenario, but I'll try to cover those as we go through. As Dwayne said, I'm in the state office here in Manhattan. Farm loan chief. I've been here since April. I was farm loan manager for 27 years in southeast Kansas and Girard before that. So I'm kind of not having the opportunity to work one-on-one with customers as much in the position I've got, but I recently came from that scenario and that type of thing. Farm Service Agency delivers farm loan programs and farm programs. Farm programs, the Farm Bill programs, livestock deficiency program, CRP, those programs that you're aware of, I'm sure, as well as farm loan programs. I'm going to talk specifically about farm loan programs. We have two primary types of farm loan programs. We have guaranteed loans and direct loans. Guaranteed loans are loans that a commercial lender provides, a bank or a farm credit. We provide a guarantee to that lender that says that if they make the loan, they service it prudently, later there's a loss, we'll pay a percentage of that loss, up to 90% of that loss, typically about, up to 95%, typically about 90%. It's the bank's loan, it's their money they loan, it's their loan to service, it's their interest rate. We're simply providing a guarantee to that lender. The guarantee allows that lender to provide credit to that farm customer where otherwise that credit might not be available. Maybe that customer doesn't have as much net worth, as margin, as cash flow, whatever scenario might be a limiting factor for that customer to get bank financing without our guarantee. We're going to get into direct loans also, but the first topic I'm going to address is the guaranteed loan program. Guarantees, loan limit is $1.399 million, 1.4 essentially. We have farm ownership loans, operating loans, and line of credits. Farm ownership loans could be used for the purchase or improvement of real estate, could also be used for refinancing debts. Typically, we're limited to a maximum of 40 years, although most commercial lenders won't want to go 40 years on these loans. We have operating loans for the purchase of machinery or breeding livestock. Can also be used for refinancing debts, 7-year term typically. And line of credits for crop and livestock inputs, a 5-year line of credit, similar to the line of credit you guys were discussing on your balance sheet program here, where hopefully they'll zero that out at some point here in the production cycle and keep interest caught up, that type of thing. And so as it relates to the balance sheet discussion you had, at the bottom we've got our short-term, middle, we've got our intermediate, and our long-term financing through the guaranteed loan program here. Direct loans is our other major loan program. Direct loans, unlike guaranteed loans, we provide that loan directly to the customer. We're their lender. We loan U.S. Treasury funds, we set the interest rate, we service the loan, we're that customer's lender. All of our loan programs, especially our direct loan programs, have certain eligibility requirements that set us apart from other lenders. We look at many of the same things other lenders do, cash flow, collateral, that type of thing. We have eligibility criteria that are specific to our agency. Those criteria include things such as the customer has to be the operator of the farm, not have incurred in various scenarios, depends on the loan program, certain losses to the agency, that type of thing. One thing that makes us really peculiar as a lender is we do limit the direct loan program to customers that have some sort of limitation on their ability to get commercial credit elsewhere. We're not in business to compete with commercial lenders. Often we partner with commercial lenders. They provide part of the financing, we provide part, but we're not in the scenario where a bank's welcoming this customer in and says, yeah, we want to come in and do business with you, that we step in and we directly compete with that lender. It's not our role. So the eligibility is limited to applicants that are unable to obtain sufficient credit elsewhere at reasonable rates and terms. Some examples of that might be a customer who has inadequate security margin. Maybe they want to buy that farm, but they don't have the 20 or 30% that commercial lender might require. Cash flow's tight, maybe it's a new operation, maybe existing operation recovering from a loss. Often, our direct loan programs, we've been utilizing those programs the past few years, emphasizing loans to beginning farmers. Somebody's been farming for 10 years or less, that type of situation. By no means are most of our programs limited to beginning farmers, but that's typically where we've been using the majority of our funds. Right now, our portfolio is about 60% beginning farmers, and we have a Farm Service Agency within the state of Kansas and nationwide a pretty significant role in assistance to beginning farmers getting started. But as we go into a situation where we're seeing some cash flow issues, some struggles with some existing operations, the reality is we're starting to see and expect to see some increased activity from kind of this bottom group here, this group that's involved in some financial losses or having some existing operations with financial difficulties. Within the direct loan program, we have farm ownership or real estate loan programs. I'm going to break those down a little bit further, kind of a subcategory of our farm ownership loan program. But I'm going to talk about down payment loans, 50-50 loans, and 100% loans. The down payment loan program is a real estate purchase program. And let me back up and clarify. When you're working with a customer, an existing operation that might be having some financial challenges, often the possibility of us stepping in and refinancing some debt becomes a topic of conversation. We have opportunities in some cases to use our direct loan program to refinance debt, to pick up that feed bill they didn't get paid last year, that fertilizer bill, to maybe the banks wanting to offload some of their debt so they can kind of clean up their relationship with that customer. But we cannot refinance debt with our direct farm ownership loan program. We've got an operating loan program we can, I'll get to that, but we cannot use it for refinance debt with our direct farm ownership program. Farm ownership loan programs are for purchase or improvement of real estate, essentially. Down payment loan program for the purchase of real estate, the applicant pays a minimum of 5% down. Our interest rate is 1.5% fixed, and all the rates I'm going to mention to you are fixed rates for the life of the loan. Dwayne's got a question, yes?
Are there any limitations of sales within a family?
No, no concerns with that. No concerns with sales within a family. Some state beginning farmer programs, and Kansas has a program. I don't know that it's terribly active, but there's a program in place. There are some limitations for that state program and that type of thing. But in our case, no problems with sales within families. Our loan is a maximum 20-year term. Under this program, we lend 45% of the purchase price, and the commercial lender, participating lender, loans 50% of the purchase price. I should say that the participating lender doesn't have to be a commercial bank or a farm credit. It could be an individual or whomever. To qualify for this program, participate in this program, the applicant must be an underserved applicant or a beginning farmer. A beginning farmer is somebody that's farmed for 10 years or less. On a real estate loan like this, they also have to own less than 30% of the median-sized farm in the county. An underserved applicant is the applicant where the primary operator is either female or a member of a protected race. 50/50 loan program is another direct farm ownership loan program, again for the purchase of land. We loan 50%, participating lender loans 50%. Our rate's 2.5%, 40-year term. Our portion of the financing is limited to $300,000. 100% loan program where we can step in and do up to 100% financing without participation. 3.875% rate, 40-year term, $300,000 loan program, loan limit. Farm ownership loans have been a very, very popular loan program. It's something we get a substantial amount of demand for. One of the limiting factors for us until the last year or so was our funding wasn't very adequate. We'd end up with a waiting list and some issues like that. We were really, really fortunate last fiscal year to have more than adequate direct farm ownership loan funds, and so it was a real positive situation for us. We're expecting to have funding the fiscal year we're presently in. The budget, the government's budget runs out December 11th, continuing resolution. We hope to have a budget soon. Don't know those details yet, but we're hoping to have adequate funds next fiscal year, and including direct farm ownership loan funds.
What constitutes beginning?
What constitutes beginning? For all of our loan programs, beginning is a farm for 10 years or less. Now,
Based on?
that's a good question, because I know what day I started the job I've got. You know what day you started your job or got married or whatever. What day did somebody get started farming becomes kind of cloudy. And a lot of the things we deal with in our programs are cloudy and a little subjective. Basically, we try to work that out with the customer. It's not necessarily an issue of, the first year they filed a Schedule F tax return. That may be an indication of when they started farming, but it's not necessarily limited to that. We don't necessarily go back and tag somebody that when they were 12 years old, dad gave them a cow or something like that. We don't count that scenario. But when they started, on their own financial and adult scenario, having financial profits and losses from a farm operation, something like that, it's typically when we try to peg that beginning date.
Is that $300,000 limit for all loans aggregated, or is it per loan?
It's a limit of, we can only at any time have $300,000 outstanding of direct farm ownership loans with a customer. Direct farm ownership loans. We're going to get to the operating loan program now, and it's got a $300,000 limit, and it can be separate, so somebody can have 300 of each. And those don't impact the 1.399 million limitation on the guaranteed loan program. So we can add programs up and get into quite a few dollars. Any other questions right now? Good questions. The operating loan program, used for annual inputs. We use the term operating loan different than a commercial lender or bank will. They'll typically use operating loan for next year, this year's operating expenses. We use it for as both a current and an intermediate term type scenario. Annual inputs, purchase of machinery, breeding livestock, in some cases refinancing debts, maximum 7 years. If we've got long-term, like real estate security available, we can actually refinance a debt with a 7-year note, 21-year amortization that includes a balloon. A fixed rate we've got available presently is 2.5%. Within the operating loan program, we have a microloan operating loan up to $50,000. It can be used for the same purposes as the general operating loan program can be. It has nearly the same qualifications and such as our typical operating loan program. The benefit could be is it may require less documentation from the customer, and the security requirements that we have for that loan may be a little bit less. Microloan program's really been a successful program since it's rolled out. We've done a lot of loans within the microloan limitation. Emergency or disaster loan program, $500,000 loan limit. The losses are the amount of the loan for an actual crop loss type situation or livestock pasture loss situation is related to a natural disaster, a drought or a flood or whatever it may be that limits production. The amount we can loan is based on the calculations of the production loss. 3.5% rate. I'll kind of, just to be upfront with you, I'll kind of give you the inside scoop on the emergency loan program, where this program is today. The last time we got into a situation where we had a substantial amount of loan demand due to financial difficulties in farm operations, if you go back to the 80s or something like this, which hopefully that's not where we're at or where we're going, but we had a huge demand for the emergency loan program. It's a very, very active program for us. Today, that program, the way the losses calculate and that type of thing, it's highly unusual when we take a look at an operation where it has a substantial decrease in production due to a drought or whatever it may be. It's very rare that the dollars of loss calculation calculate high enough to do anybody any good. The reality with crop insurance, benefits, and other subsidies, and possibly disaster payments from FSA, that type of thing, the reality is we have just really, really minimal activity in the emergency loan program.
To that point, how do we stress to an FSA executive director that they need to be out and surveying hail damage, even if it's on the floor of the county? Like, we serve a district, one county is out and he is going through, has that accumulated loss. One in the middle is not. And so the chances of ever getting that loss, hitting that number for that disaster is based on them taking the initiative to go out and survey the damage.
Yeah, everybody heard the question, I suppose. It's a good question. I guess continued dialogue and explanation and encouragement would be my suggestion. If you run into what you think is a major issue, a serious roadblock, you could always visit with the district director, the CED supervisor, to see within their district if they think it's appropriate for that CED to try to be a little bit more aggressive in loss reporting. I will say, it doesn't negate the fact that needs to be considered, but I will say that within our loan program, we are able to consider not only declared counties, but also contiguous counties. And so your explanation for our loan program, the net result is we really wouldn't be hurt in that county that had the impact but didn't get declared because we got a declaration in joint county. But again, that doesn't negate the fact that it should be considered if the disaster occurred. That's a good point. Youth loan program. We always like to have the opportunity to mention to extension employees, remind them of the youth loan program. Some extension employees utilize this program quite a bit. It's certainly a very valuable program. It's a youth loan program for applicants from 10 to 20 years old, participating in 4-H or FFA programs. It can be for a wide variety of ag-related purposes. 2.5% rate, $5,000 loan limit. And it's the opportunity for a young individual to accomplish two things. One, to get credit for some sort of project. But secondly, and we view it as more importantly, the opportunity for that young individual to experience the business side of obtaining credit, working with us to service that loan. We go out and do inspections. We do a lot of the same kind of things we do with any other customer we have. And try to give them an educational experience about the business aspect of that. They do a cash flow projection. It's an abbreviated projection. It's nothing like FinPack or anything like this. And they're responsible for paying the loan back and that type of thing as well. And if you've got individuals you're working with that could be interested in the youth loan program, it's certainly a good idea to pass that along to them. Our interest rates are available at this website. I hesitate to even include the website on there because really, if you want to know the rates, it's kind of a tricky backdoor way for me to suggest. But call the FSA office and ask the rate. The advantage to me from you calling the office and asking for that is that that's one more opportunity for you to have some discussion with our offices, get to know our employees. Hopefully they're coming out and communicating, working with you and vice versa. But as we, especially as we go into a scenario where some of our customers are experiencing some challenges and you're working with that, and we appreciate that you're doing such, that the communication, the opportunity to interact with our offices is something I really encourage. In addition to guaranteed loans and direct loans, we have a farm storage facility loan program. Farm storage facility loan program, typically in Kansas, is used to construct grain bins, sometimes hay barns, that type of thing. You get into details of how we administer things within our agency. It was recently handled by the farm program staff, but Farm Loans is handling that program now. It's unique for anything else Farm Loans is handling because it does not include a requirement that applicant be unable to get credit elsewhere. Somebody can go to us and have $1 million cash on hand, and they want to borrow money for a grain bin. We can certainly help them out with that. 1.75% rate for a 7-year term. A rate that's hard to beat. It's a really good program for someone looking to put up grain storage or something like this, and especially in the price environment we're in, if there's some marketing opportunities by having on-farm storage or something like this, it's something that people would consider. So in summary, these are our loan types. We have guarantee and direct loans, farm ownership, operating loans, line of credits, emergency and youth, as well as farm storage facility loans. As you're working with potentially an existing FSA customer that's experiencing some financial distress, one option that they may wish to consider, they may want to visit with our staff about, is our loan servicing opportunities. Primary loan servicing has the opportunity to assist existing borrowers that are unable to make payments due to reasons beyond our control, that we can assist them. Those include, here at the bottom, consolidation, basically wrapping loans up and putting them into one loan. Reschedule and reamortization, that would be taking the balance of a loan with maybe a missed payment included in it and rewriting that loan over the remaining term of the note. Deferral, taking a payment that recently was due or is coming due and putting that on the back side of the note. Interest rate reduction, if they're a loan that was written, they're in a higher rate environment, we can work with them maybe to lower that rate. And finally, write-down. Write-down's not necessarily going to be available for every applicant, every borrower in every case, but it's a scenario where we're realistically undersecured, and we have an opportunity to reduce the amount of debt that borrower owes us, not below, no further than what our unsecured position would be. So we're not going to go from a secured position and write down debt. But if we're undersecured, reduce our amount of debt based on that undersecured amount relative to what they've got the ability to pay. A little bit about kind of I don't know how many of you may be familiar with what kind of activity we've got within the Farm Service Agency, just kind of give you some clarification relatively what our volume is. In the last fiscal year that ended September 30th, we obligated funds for 1,359 farm loans in excess of $192 million. Currently, our portfolio is about 3,600 direct and guaranteed borrowers and a little over $700 million on books. If you're like me, 192 million is kind of a hard figure to understand. I've never had 192 million. I don't know what it looks like. It's interesting to me to put in these terms that for every business day last year, we loaned about $766,000. As you're talking about borrowers that are having some financial difficulties and that type of thing, it's relative, a very good question. A question I get a lot is, how's our portfolio holding up? And curiously enough, and as I talk to other offices, other states, other lenders, that type of thing, I'm hearing the same kind of response. Our delinquency rate hasn't shown an impact from lower commodity prices at this point. It hasn't yet shown that. Presently, our direct borrowers, 2.87% are past due and less than 1% of the guaranteed loans behind schedule. That compares pretty consistently where we've been the last few years. And as an ag lender, that's a pretty respectable delinquency scenario. As you're working with customers and offices, FSA offices around the state, here's a map of how we're organized. We've got 21 farm loan offices in the state. At the bottom, and you probably can't read it here, and I don't know, you're not going to be able to read it, it's your handout either, but at the bottom are the names of the farm loan manager in each office, and then the contact information there. And again, hopefully you may have an awareness of who your farm loan staff is there in the office. If you contact the local FSA office, even if we don't have a farm loan team in that office, they can certainly put you in contact with the farm loan team, or the information, you can just go on Google FSA and it's got a pretty easy direction that you can link to local office contact information.
Bob, is this on a website online? Is this map and contact?
This exact map is not on the website. What you're going to find if you go on FSA's website is they're going to have a link to state offices, so you can link there and you get to Kansas. And then within Kansas website, there's going to be a link to county offices. And then you're going to be able to locate, and it's going to tell you, for example, if you pull up Morton County, it's going to give you the county executive director, the CED's contact information, Morton County, and it's going to give you the contact information for the farm loan manager in Hugoton, which services all of this area. It's a relatively easy step to go through to link that from the FSA website.
Okay.
And my contact information, and again, anything me or my team here in the state office can do, as well as our county offices, we appreciate the opportunity to help you in any way we can. And again, I really, really do appreciate and the effort and encourage the effort that you guys are undertaking to set up and have a system in place to be able to help what could be a pretty substantial number of individuals who are concerned about the financial viability of their operation and what options they need to take a look at. We're having similar discussions with our staff as well, of course. And we're talking to our staff. We've been in more of a loan-making mindset the last few years. Our loan activities just keeps going up and up and up. We loaned a record number of dollars last year, and we've got a bigger caseload than we've ever had. We don't want to ignore the opportunity to help people expand or get into agriculture. We still want to be making loans, but we're also going to have to take a look at more servicing options and opportunities to try to assist our existing customers to remain financially viable as well. And in doing so, just last night I emailed our staff. I was at a national meeting last week, and this was kind of the topic of conversation, the primary emphasis of the meeting. But we're directing our staff that we need to take a good look at the financial information. It's not beneficial for us or for the customer or for anyone to provide financing on a situation that realistically isn't going to work. We don't want to set somebody up to fail. At the same time, we we don't think this is the environment where we need to come out and say no to everybody by any means either. We're not doing a 180 from going from a loan-making mindset to turning everything down by any means. We want to be reasonable and moderate and appropriate in the way we consider and analyze these cash flows and deal with our customers. The reality for us, when we have a customer, maybe a new applicant that comes in that's having some financial stress, or an existing customer that we've got, there's room between, there's a lot of space between saying, yes, that first proposal you've got, that initial, just make you a loan based on what you've always been doing, how you've been doing business the last few years, and then the alternative is to say no. And there's a lot of space and a lot of opportunity in between, a lot of conversation there. What options do these customers have to get into a feasible, reasonable situation that if they may not be today? Maybe restructuring some balance sheet, moving some short-term debt into longer-term debt. Maybe taking a look at the enterprises they have which may not be profitable. Maybe being able to reduce some expenses, be it farm or non-farm expenses. Maybe be able to pick up some supplementary income by some manner. So there's a number of options that is going to, we're going to try to gear up to be able to have those conversations and be effective with those conversations with our customers too. Questions? Dwayne has questions.
Yeah, two questions. One, going back to your map there of the service centers and where people are located. Is the farmer, if he resides in a county but has farm ground in another district, can he choose which service center to go to?
It's not necessarily we haven't really opened the door to say it's the customer's choice where they go. If the customer lives on the farm, then it's typically going to be the county of their residence. If the customer lives off the farm, maybe they've got a house in town and operate a farm, it's going to be where the headquarters is considered to be.
Second question is, you talk about years of eligibility, and if they exhaust that, for instance, on the operating loan, what other alternatives exist? Just a guaranteed operating loan? And I assume that 5 years, for instance, starts and is contiguous, or if they have a year where they don't need the operating loan and then fall back into a status where they do you go by the years that they actually qualify for eligibility, or does it just a straight 5 years from the beginning and then that's it?
What Dwayne's referring to, I mentioned that our role, our directive is to assist customers who are unable to get credit elsewhere, that we're not set up to compete with commercial lenders. And one of the ways that Congress has emphasized that limitation is by placing term limits on our loan activity. That doesn't mean that once a loan is written, we can continue with that customer as long as they have the financial need to stay with us. Now, once they reach the position where they clearly can get credit elsewhere, we should ask them to graduate to other credit. But the term limit impact is a scenario where it's our hope, it's our intent to help a customer that's getting started or going through a difficult time, but that they're going to continue to make some financial progress and that they're going to get back into the commercial financing where they should be for their agricultural credit needs. To emphasize the need that customers need to do that, Congress has placed term limits on us. Basically, our direct operating loan program, an applicant has 7 years in which they can obtain an operating loan from us. Not 7 years they have operating loans outstanding, but 7 years they can receive a new operating loan, and they burn those years of eligibility up as they get operating loans during those 7 years. And it can be an impact. And if we get into a situation where an applicant is in need of an operating loan for crop inputs, machinery, refinancing, whatever it may be, and we've burned our years of eligibility up, then yes, the alternative opportunity that we can take a look at with them is a guaranteed loan or something like that. Other questions? Okay, very good. Well, again, I appreciate the opportunity to visit with you, and I do think it's a great effort, a great project for you guys to take a look at what you can do to assist these individuals.
Let's thank Bob for coming.